We are live. Warning, USA, and by that we're talking about the military complex wants war with Russia. Buy this portfolio now. We just had a press conference less than a couple hours ago. That's caused the stock market to sell off. And what comes next could very likely benefit our portfolio dramatically. This is a $10,000 trade alert for our high risk portfolio. Okay, is this specifically for people on a free trial who want to get a taste of what we have to offer? Of course, if you upgrade, you can customize a trade alert for any amount of money. Step one, pick up 91 shares of UVXY. That's trading up as much as 20%. It's up 20% right now at 16.94. Okay, so this thing could skyrocket if the worst outcome happens. And again, in March of 2020, this position went up 11 times, 1,100% return in less than 4 weeks when you get a black swan event. We've got Putin threatening NATO with nuclear war if they don't back off on Ukraine. Both sides are building up military as we speak, and the US State Department just warned that they could very likely invade next week. Step two, pick up 227 shares of ETHE. That's trading a little bit down right now, a 5% sell-off. There's a lot of cryptocurrency in Russia, and we're seeing risk assets sell off pretty precipitously right now. We got Bitcoin down 3%. Funny, Bitcoin's less volatile than the NASDAQ. If you are all in on tech stocks, you're having a pretty rotten 3 months, 3.5% decline on the NASDAQ, down, outpacing the SPY, which is only down 2%. And then emerging markets outperforming all other indexes, only down 1.6. That's where we have our safe growth investors heavily invested. And again, in general, I think the bond market crash has been dramatically overdone, that we're going to see inflation fall for the remainder of the year, and that peak yields are very likely here, which is the main threat against tech companies. Here's a look at that ETHE chart, and I do think we will see new highs this year. So you could very easily double your money with Ethereum with Grayscale Trust ETHE. Now, this is probably the more likely immediate returning asset for a Russia-Ukraine escalation. And so the threat from the State Department is not necessarily that we will fight Russia. However, we are threatening to sanction, and specifically block them out of the SWIFT banking system. And I don't think Russia really cares, because they know they can cut off natural gas to Europe when inventories will hit a low in March. So Putin's got us by the balls here. Meanwhile, the US bond market is continuing to crater due to too high of inflation. So if these energy prices stay elevated for much longer, this is going to put more and more pressure on the US government's bond market, and thus in turn the equity market. So we're recommending a large 102 position in BOIL. All signs point to BOIL skyrocketing in the next few weeks if this confrontation escalates. And at this point, it does seem the US and NATO really want this to escalate. Here's a look at the chart. We did see it double and come right back down on us in a flash. We did not react fast enough to sell because we were waiting for the big conflict to occur. And it looks like that conflict's going to happen probably within the next 2 to 4 weeks. So we'll be timing the sale of BOIL most likely towards the peak of this conflict, which could start to take off in the coming weeks and maybe next week. Here's a look at the asset allocation breakdown of your $10,000 trade alert in the high risk growth strategy. The UVXY, which was at 10% just 2 days ago, has jumped to 14.5%. So if we do get another market meltdown, this is ample insurance to completely protect against a significant panic in the stock market. So right now we have not increased that position. We've been letting it ride after increasing it several weeks ago. Meanwhile, we're betting big on Ethereum, which is essentially replicating the US banking and insurance and stock brokerage system into DeFi extremely successfully right now. And I do see great upside for Ethereum, especially now that we've gotten through a 55% correction in the asset, which has been due to the bond market crashing. And again, all signs are of a dramatic slowdown ahead, which should drive yields to actually fall from here. I believe we had the worst of the inflation scare with the latest CPI print. Well, look at that, did slow down, which is what we were hoping for. So we really just need to get these energy costs down, and then it should be smooth sailing for technology, NASDAQ, Ethereum. And again, the main thing that's going to hold that back will be oil staying elevated due to this conflict. So this could be important to play. Now, oil's already at a relative high we haven't seen since, I think, 2014. Natural gas is way below its recent high seen last August, when the US had to ship lots of gas over to Europe to save the day. So if Russia really does react to the US, cutting them off the SWIFT banking system, oil could go parabolic. So very excited. And this is actually the ratio we were looking at having. I wish we had cut the position in half, because we could be doubling back down today. At this point, this is a great setup. And again, this is really bulletproof for a conflict with Ukraine. Now, if nothing else happens, most likely we're going to see Ethereum rocket higher, yields fall, and we can look at a better play than oil. But again, right now, it just does not look like things are about to de-escalate. So it makes a lot of sense to have the double hedge against this conflict. And again, UVXY protects you against stocks going down, and then oil protects you against energy shortage in Europe that could be escalated from Russia very easily. Now, our high-risk growth portfolio returned 233% in 2021, turning every $10,000 into $33,000. Are you ready to triple your money? Here's the big picture. The global economy is slowing down. I believe inflation will peak by March and fall for the remainder of the year. This means bond yields are probably as high as they're going to go in the short term without significant new fiscal stimulus. And now it's starting to look as though the inflation may not slow down fast enough to pass Build Back Better bill at all this year, which is what would make me think the inflation could rise once again. And if we're about to have the Senate and House switch red, we could be going into gridlock all the way to the election. So it'll be very important to watch that yield curve invert and to be positioned for what's coming next. The CPI Thursday did show a slight slowdown in the rate of change of inflation. It went up a lot, highest print since 1982. And now bond market, everybody's thinking it will never end. I actually think we are very near the peak inflation and that it's going to start falling. And that means yields go down. And I'm actually expecting this to be the perfect environment for our growth asset, Ethereum. Key macro events ahead. The NATO-Russia-Ukraine conflict may escalate soon. We've been saying this for a week. Today we get that news. Last week we had, or maybe it was earlier this week, we had Macron go over to speak to Putin and supposedly de-escalate it, but that was short-lived. So right now, we really got to evaluate our options. Do we go to cash when governments globally are spending more than they make, devaluing their currency? Not a good position. Do we go to bonds? There's been a big sell-off in the TLT, which is the long end of the bond market. And I got to admit, it's starting to look attractive. It had touched a very critical level, which was below 136. And then we had this news come out today of imminent war with Russia and Ukraine, and those yields have popped back up. But in the short term, bonds are still ugly, and it's going to take a while to have evidence that the inflation really is going to fall towards those yields. So bonds are still ugly, but they're starting to look a lot better. I've been tempted to start to allocate some capital into bonds for our clients, but I think we need to wait for this conflict with Russia to be resolved so that energy costs can fall, which will be very important for CPI. But yeah, this is the big picture with treasuries. My expectation is they will top out at the 2.5% to 3% range. And the CPI, which just hit 7.5%, is going to fall back down to 3%. And as that's occurring, you're going to get a very good entry into US treasuries. So we're just not there yet. Today we have the 30-year trading at 2.24%. So if we go up another 25 basis points, we're getting into range of where I think we want to be a buyer of US debt. So not quite there. And I actually don't think we're going to get there anytime soon unless there's more fiscal stimulus to put more pressure on inflation. And it looks like that is just not going to happen anytime soon. So right now, investors have no other logical option. You want to be long your stocks, your cryptocurrencies, your commodities. These are likely to continue driving a bid until the bond market becomes competitive and attractive. And it's made some big moves to get there, but it's just not there yet. That's why it's important you watch our webinar every Monday, Wednesday, Friday to be ready for sell alerts. The next sell alert will be taking profits on Boyle. And I'm actually looking at rotating into RSX after we get a significant sell-off in the cost of oil due to a de-escalation in Russia. So I think that's going to potentially see RSX get beat up during this conflict. And then once the conflict's over, we should see the cost of oil fall. And then that's setting up for a beautiful new inflation energy hedge after all this mess plays out. So to be clear, Boyle should go up as the conflict with Russia and Ukraine and NATO escalates over the coming 2 to 4 weeks. We will sell that position and then we're going to need to wait a little while for the cost of oil to go down. And then it looks like RSX can be a hell of a play to get a discounted investment into energy products. So that's what I'm anticipating in the near term, and we could potentially be selling UVXY, reallocating some capital, most likely into Bitcoin and Ethereum or the NASDAQ, expecting rates to fall for the remainder of the year after this conflict comes to an end and energy costs can start to cool off. So don't forget to upgrade. There's 3 spots a day that Dean lets investors in at a special deal. Call him now at 505-322-7515 to upgrade your membership. Okay, so let's look at our 2 portfolios. The safe growth strategy and high risk are having some volatility. We're down 4.5% in the safe growth after returning 1.5% in January. And in the high risk portfolio, we returned 9.9% in January, and we're currently sitting on 9.5% drawdown in February. I really like the way we're positioned, and I'm not worried about turning a profit into February, especially for the high risk portfolio, which has 2 big bets in Ethereum, which will do very well if energy costs can come down and rates begin to fall. And then UVXY and Boyle if this conflict spirals out of control. Now, if you do upgrade, you'll gain access to our membership area where you can actually type in how much money you want to invest into each strategy, and it will print out exactly how many shares to purchase. In general, we recommend doing a 70% safe growth and a 30% high risk strategy. That combination doubled your money in 2021, rebalancing at the start of each month. It delivered a 5.5% return in January We're currently having a 6.8% drawdown in February. Okay, very good. Let's jump into the content. Okay, so we'll start off with the hot news feed, and then we can look at charts and data. Okay, so reporters have been asking the State Department what evidence there is of an imminent invasion, and of course they aren't willing to share that. We got a joke about that from Zero Hedge. There was a pretty funny clip last week, I believe, where a reporter really did question the State Department, and he couldn't really answer the question. But meanwhile, we've had Bloomberg leaking headlines that Russia had invaded Ukraine before it had happened. We've got NATO countries evacuating citizens, and we do have a continued buildup of military across all these borders and ships in the Black Sea. So from my perspective, it does look like this will escalate into the coming weeks. Other news we have, and so also, is the Fed really going to end QE and hike rates in the midst of a potential pretty dramatic escalation of war with Russia and maybe China backing them? So we'll see. We're just going to see how this plays out. The Michigan sentiment indicator fell precipitously today to recessionary levels. Again, and the question is, are we really going to cut off access to capital into such a dramatic slowdown in the economy? Now, potentially, the reason for such bad sentiment and for such bad bond market returns could be that the Fed is refusing to hike interest rates and end QE. So I'm almost wondering if the stock market would love rate hikes because it would start to squish these expectations of out of control inflation. And that's why we continue to remain positioned how we are, because there's really no other alternative investment that makes a lot of sense right now. Charlie Bolello says the 1, 2, 3, 5, 10-year yields are at their highest level since the start of the pandemic. And the 2-year has just done this wild movement, went straight up, straight down, straight up. And now, what's going to get these yields to come back down? And I actually think once they start to hike rates, the bond market is going to cool off, and it could be very bullish for markets in the short term. Peter Schiff says investors are buying U.S. Treasuries as a safe haven, given heightened geopolitical risks are making a big mistake. Inflation pressures will actually intensify if Russia invades the Ukraine, which will further erode the value of bonds. The real safe haven, of course, is his favorite, gold. Yeah, that's an interesting, very interesting point. The energy costs are going to go up if this does continue to escalate. So typically money that could go to bonds might be looking at worse inflation. US to send 3,000 paratroopers to Poland in the coming days. Zero Hedge asks, has the Fed ever hiked interest rates into a world war? US intelligence community believes Putin has decided to invade Ukraine. US Embassy in Ukraine, US citizens in Ukraine should be aware that the US government will not be able to evacuate US citizens in the event of Russian military action anywhere in Ukraine. Military action may commence at any time and without warning. Lynn Alden, most views on inflation seem to be rather binary. Examples include inflation will peak by the end of Q1, go back to normal, and it will have been transitory. We're entering secular inflation. It won't peak anytime soon. There are views, however, that can include elements of both. For example, inflation peaks by the end of Q1, goes flat or down a bit, but remains above target, and then has another spike in the years to come. Secular inflation, but not in a straight line. That's actually what I'm thinking if they pass the Build Back Better bill. That we're going to peak out in March, which is where energy costs went negative 2 years ago. So the relative change of inflation will be very well positioned to fall after March into April. And that's what could potentially spark more stimulus, which would re-engage inflation expectations. Now, the next fellow says typically the Fed has to hike rates above the inflation to cool it off. And so you can see we are way below the inflation or the CPI with our rates. We've got them at 0 while inflation's at 7. And Lynn Eldon says that the problem is, comparing this to the 70s when they did do that, is the debt to GDP ratio was far lower then than it is now. She says this is more like coming out of World War II, where we had to essentially keep rates low behind the curve due to too much debt. And again, now the US debt to GDP, I think, is at 135%. So we can't afford rates to rise very much. And that's why I do think peak rates will be no higher than 3% before it would crash everything around it. Weakest consumer sentiment in a decade. The Fed solution, let's choke off the private sector by abruptly increasing their borrowing costs. Now, again, would the bond market calm down if the Fed starts to hike rates? Perhaps. Christine Lagarde from Europe warns against raising rates too fast. The Chinese government started buying stocks this week, and they've increased credit by about $1 trillion. So it's interesting to see emerging markets sell off less than US markets as of lately. And again, that's where we've been allocating capital for our safe growth strategy as our single largest position currently. A big threat about China. They're still doing the no COVID policy, which is going to keep the costs of imported goods high for the time being. New York Times, Russian troops have gathered near the border with Ukraine, but no one knows what Russia's President Putin plans to do. Live Monitor says something is certainly up, lots of rhetoric ramped up. Goldman Sachs says we would consider changing our forecasts. They still think only a 25 basis point hike in March. We'll look at those probabilities. It's down to 48% yesterday. I think it was at 100% almost, but that's because that 2 years come back down today. So interesting market action. Following this morning's strong CPI print, we are raising our Fed forecast to include 7 consecutive 25 basis point rate hikes at each of the remaining FOMC meetings in 2022 versus 5 hikes in 2022 previously. Macron refused to take a COVID test when visiting Russia due to not wanting them to have his DNA. And again, the rhetoric is ramping up. So I think that's really the key headlines here. Okay, so let's go ahead and look at the bond market here. In general, the rates keep rising, but the front end is rising far faster than the long end. This can lead to a yield curve inversion that tends to signal a recession about 12 to 16 months. Now, it's actually when the long end steepens that we get the big crash. So we'll look at that trend, but at this point, there's still a 50 basis point spread between the two. As far as rate hikes, unless it's above 50 basis points in March, I think this is already priced into the bond market, and that the Fed's going to be relatively tame in response, these 25 basis point hikes until the inflation's falling. The reverse repo still stubbornly at $1.6 trillion. So this is still a quantitative easing buffering, even though we're going to end QE in March. Here's the Boyle versus NRGU. For a split second, we had Boyle outperforming NRGU. And then we had the Macron talks, and energy for natural gas costs came down dramatically. And meanwhile, oil's kept going higher. All signals tell me oil is going dramatically higher at this point. So we remain long, and this is the perfect setup. Lumber futures have been going limit up every day. We did get a little pullback just today. But again, this has been predictive of oil prices. And so we got a warning sign of May last year that oil would crash 2 months early, and it did. And then we had a run up in lumber futures predicting oil would go up. It sure did. And today, lumber futures are predicting higher prices. So we've got oil, lumber, both predicting higher natural gas prices in the near term. Now, copper futures had skyrocketed up, pulled back on this war news, but still in a strong uptrend. Baltic Dry Index, which had been crashing for several months now, getting a bid back up higher. The greatest pain continues in the NASDAQ, and this is with rates rising, so that makes sense. Now, I do think rates are going to top off, stabilize, and fall for the rest of the year, and that only a massive surprise in inflation in February, March, April could change that course. So, boy, oh boy, look at that NRGU. We sold too early, so I know everybody's not happy about that, but Boyle should still outperform in the coming weeks. Here's that RSX relative to rates and oil. You can see in green the RSX. I'm going to wait for us to sell Boyle, for the conflict to end, and for oil prices to fall. And I think we're going to get a really nice opportunity to buy RSX for the high risk portfolio as the new energy hedge. So keeping a close eye on that. We'll also consider NRGU at that time. But yeah, I do believe these energy costs are going to come back down before they head to new highs after this conflict is dealt with, and that could be weeks away. So we'll keep a close eye on it. Here we have emerging markets against interest rates, and we're starting to see less drawdown in emerging markets relative to US markets in this current sell-off. And this is where we are heavily allocated in the safe growth strategy. In this chart, we're looking at the Russell 2000, which had been trading flat all year with rates falling, which I thought was pretty bullish because it typically only goes up with rates rising. Now we've got rates rising, and we're starting to see Russell 2000 catch up with those rising rates. This is probably the most bearish stock chart we have of all stock charts. That and that 2-year just relentlessly going up on the US debt markets. Okay, here we have European markets. And again, you can see the sell-off in rates and the sell-off in Europe. This might be a position we could let go of to buy treasuries in the short term for safe growth if we're really going to get a big conflict over in Europe. So that's a trade alert I'm considering at this moment. Here's our dollar index getting a little bid on this news. Nothing too crazy happening here. A big repositioning for the portfolio will occur if we touch the 90 level. And that would want me to go long treasuries, the dollar, and we're a long ways off from that. Current positioning is very good for the dollar to fall. Here's a look at the tech sell-off. So we got rates going down and tech companies going down. That's a risk-off move, obviously. But in general, getting these rates lower will be good for tech once the scare of nuclear war slows down. But we can see some pretty good volatility in tech stocks. Microsoft down 2%, Apple down 2%, Amazon 2%, Google, Tesla 3%, NVIDIA 4.7%. Meanwhile, over in the other spectrum of large cap S&P 500 companies, we can see over this period rates rising, and we've seen a nice return in JP Morgan up 5.7% over this period. We've got Berkshire Hathaway up 4%. So we're starting to see that rotation out of growth into value. But at this point, I think rates are pretty much topped off, and I don't see much reason for them to rise any further in the short term. Over in Asia, we're looking for some of these key companies to start to rebound. Alibaba, Tencent, and Taiwan Semiconductor, all trading in lockstep now. If we zoom out a bit, we can see there's a lot more pain in the Chinese company Tencent and Alibaba, while Taiwan Semiconductors has traded very strong and is probably one of the most important companies in the world right now. Europe, we track Toyota to look for any significant problems coming, and this chart just keeps climbing higher and higher. And then over here, we're looking at the chart of Exxon. And again, these energy costs are going to become problematic for politics here and inflation. So this conflict with Russia is not going to help the inflation picture at all if it continues to escalate. Okay, here's that yield curve continuing to flatten. Now it's down to 42 basis points. So if I zoom out a bit, typically what happens is yield curve inverts and then it steepens. And the steepening is what crashes the markets. So for this to invert, let's say it's going to invert, the long end is going to fall relative to the front end. Okay, that'll be good for our Ethereum position. Then the long end starts to rise, and that's when we need to become panicked. So the TLT breaking significantly lower is going to be our greatest fear for a stock crash. And again, we're approaching that moment in time to worry about it, but not there yet. And so you can see the inverted yield curves when the line goes below this black line, and it's happened about 16 months ahead of each recession. So again, headed that way, not there yet. Here's that TLT. The line in the sand is around 134. I do not think we are going to go below that anytime soon, not without more fiscal support. And we're not going to get more fiscal support until the inflation comes down. So I believe the pain in bonds is very near over, and that we're going to see the TLT rise. I'm tempted to add treasuries to our portfolio next week, even if it's just a small position. But again, the conflict with Russia could drive those energy costs up. So being a little bit patient on that front. Here's the Tesla Ethereum comparison. And so this was predicting Ethereum would catch up to Tesla, or Tesla would catch down to Ethereum. And so we'll see how this plays out as this conflict potentially escalates into next week. Starting to see a little bit of a bid in gold and copper. These two are up 5% in the last few days. We're not in gold or silver currently. We can see UVXY is up 20% on the day. Treasuries had a little bit of a bid, but nothing too crazy. Let's see if we can show a return on TMF. Not yet, because it did start the day down until this headline came out. Okay, we're also long uranium and rare earth metals in the safe growth strategy. And we can see of the four, uranium outperforming 10%, rare earth metals 4%, and that's from January 22nd, where we're starting to see this rebound. All right, let's look at some of the volatility starting to occur in crypto. Pretty impressive that we're seeing less volatility as of lately in Bitcoin compared to the NASDAQ. And again, this to me is signaling that we should be at peak interest rates. So I think we're about to have a melt up in crypto, as long as these yields can stabilize or fall from here. Dr. Copper predicts rates by comparing the price of copper to gold, and it's still in a bit of an uptrend. So with gold getting a bid and copper selling off a little bit in the last few trading days, perhaps Dr. Copper is finally predicting rates can stabilize from here. Okay, Steven's asking who buys treasuries. Mostly big governments buy bonds, but yeah, also hedge funds, pension funds, the whole world. Most of the world has almost half their assets in US treasuries. And you got to also realize anyone who has lots of debt, wants to service debt, they like to hold treasuries instead of cash for that cash flow. Big banks need treasuries to pay depositors. So yeah, there's a lot of need for high yielding debt at 2.2%. Okay, here's our yield curve. It's the wrong shape completely. They want it to look like this. So too much stimulus. They overdid the stimulus. This is right before Trump and Biden passed $3 trillion in spending we didn't need, and they screwed up the bond market. And now they've got all kinds of problems here. The VIX is slanted down, so any more selling and UVXY goes parabolic. You can see how quickly this changed shape. So last update, this was slanting up. We get a 2% sell-off in the S&P 500 today. And where did we end up? 1.8. And this thing shapes up. It's ready to go parabolic to the upside if there's further selling next week. And at this point, I would want to dump UVXY and buy the dip in our stocks and commodities during the escalation. I don't see this headed to nuclear World War III right now. But again, that we'll have to just see how crazy these people get. Okay, the disease is disappearing. Not a lot of debt being issued. We have filled up the coffer. Janet's raised like $700 billion in the last few months. All right, here's the critical CPI print. So it went up 0.6 the previous month over month, and it dropped to 0.5. That's what I was hoping for, that we'd be at 6.1 or less, and that this rate of change will slow down. So I still think we have a higher print in February and maybe March, and then it starts to fall. And the bond market's going to love it, and Ethereum's going to potentially be the greatest returning asset in our portfolio by far. And I would say the NASDAQ should do well as well. And treasuries. So I think treasuries, Ethereum, and the NASDAQ are going to be the three big winners this second this conflict is finished up and the cost of oil falls back down a bit. So we'll keep a close eye. If I'm wrong, the next print will be a similar jump to 6.5. So I think we could stomach maybe one more print at 6.5, but I would expect it to slow down in February, March, peak in March and fall in April. And again, if that happens, this will be very, very bullish for the bond market and growth assets. So that'd be technology stocks like the NASDAQ and Ethereum. Okay, producer prices, we need to stop going up. These continue to surprise to the upside. The jobs print was garbage. We're going to ignore that. They definitely just changed every number over the last few years. You can't trust the data whatsoever. So let's see what the next few prints look like. Wage pressures are rising. So we're going to keep a close eye on that. But now it's wages, rent, and energy that are primarily driving the CPI. It looks like used car prices are finally topping off and falling. Housing prices are falling. Okay, labor force is starting to rise a bit. This would change our perspective on the inflation from wages if this keeps rising. So this is in an uptrend now. The expansion of credit is good for stocks. So that is great when we're slowing down fiscal. Consumer credit continues to grow. We had one negative print on retail sales, but nothing to freak out about. Those were still at record levels. To be betting the dollar is going to go down, we just need to run big deficits and big negative trade balances. Check mark there. That's how we're positioned. China's PMI slowing down. All data is showing that everything's slowing down right now. Imports and exports remain elevated. So not fearful of a crash, just a relative slowdown. And with all this talk of tightening, the Fed laughably still keeps printing money. And so we are at a new high of $8.87 trillion printed by the Federal Reserve. ECB just printed a new high. So yeah, we'll see just how hawkish they really get here. Okay, we're about to reveal our exact trade allocations. And if you're watching this on YouTube, you're going to get cut off right here. You need to call Dean and upgrade at 505-322-7515. Okay, I'm going to go ahead and cut off that.